What we're going to do now is we're going to have a look at the tradable currency that we can trade in the markets or try to make money from when we have exchange rates that go up in value or down in value, and we're betting on which currency is likely to go up in value against another currency. Because there are some currencies, guys, that we cannot trade, and it's based on the regime set by a country's government and a central bank, based on really helping their economy to become competitive in a global market and help their citizens become as wealthy as they can from the regime set by the central bank and government. So when we are trading the Forex market, for an example, guys, for speculative purposes, which is what we're doing, we're trying to make money. That's the whole objective of us trading the currency markets. We need to know which currencies are volatile in their exchange rate and which currencies don't really move at all in their exchange rate, because that's the opportunity for us to make money, volatility. The more price swings we have in an exchange rate, the more opportunities we can make money from the changes in the exchange rate and try to have some profit when we're in the market and we are investing. So we seek out volatility. We need to understand what makes a currency move in value, what are the factors that could affect the currency's exchange rate value, and then we need to be paying attention closely to these factors, because it's going to give us money-making opportunities when situations occur, which I'm going to talk about a lot more in the videos preceding this explanation. So what we need to do first of all is we need to organize the world's currency markets into currencies with high volatility and low volatility, so we can assess when things happen in the markets which are the best currencies to buy and the best currencies not to buy, so we know where to optimize our money to make the most return, the highest return we can in the currency market. So there's two types of regimes set by the government and the central bank, and that is a fixed exchange rate and a floating exchange rate. So what's important for speculative traders is to understand what creates volatility in the exchange rate and what countries have currencies that are exposed to the fundamental factors that create volatility for us to make money from. So we need to understand the difference between a floating exchange rate and a pegged exchange rate, so we know which currencies to buy and trade in the market, and which currencies just to completely leave alone and not even waste our time when we're trying to trade. So there's two types of exchange rates that we need to look at, regimes. We have X commodity floating exchange rates, X commodity pegged exchange rates, commodity floating exchange rates, and commodity pegged exchange rates. We're going to look at this now in a lot more detail. So a floating exchange rate basically means an exchange rate where the value of the currency in the exchange rate is determined by the supply and the demand for a nation's currency relative to another country's currency. So which currency has more money coming into their country to buy their goods and services relative to how much money's coming into another currency to buy their goods and services or their financial assets, for an example. And this, whichever country has a higher demand, is going to be affecting how much a currency is being bought. And then also on the flip side, there is a supply of a currency which is being determined by a central bank when the central bank is setting interest rates. So it is really important to understand what creates the demand for a currency, and why is the supply of a currency being increased by a central bank and decreased by a central bank. And that's all to do with interest rates and inflation. And that's the central bank basically trying to maintain the value of a currency not being eroded from inflation. So as you know, central banks have usually in the advanced economies around a 2% inflation rate. Some central banks have different inflation rate targets, and they're injecting money into the system to try to stimulate inflation, or they're withdrawing money from their economy to try to cool down the demand for goods and services if inflation is rising too fast, for an example. So an increase in the money supply is used by a central bank when it's lowering interest rates and it's injecting money into the banking system to increase growth or employment and inflation. Okay, we're going to look at more of this later, but just understand when a central bank is increasing the money supply, they're basically trying to get economic growth to expand. They try to help people getting to work, and they're trying to lift inflation to their target of, let's say, 2%, and it's currently at 1%, and they need to get inflation up to 2%, then they're going to increase the money supply so that there's more money going around and there's more money being spent on goods and services. So the demand for goods and services goes up, and it raises the prices of everything in an economy and hopefully brings it to around their average target of around 2%. If inflation is going too high and it's above 2%, let's say it's at 4%, well, there's a problem, because if people's money is not buying as much goods or services as they were previously, then basically people are becoming poorer unless their wages are increasing as well. So what a central bank can do is it can start to decrease the money supply and take money away from the economy, so there's less money chasing goods or services, and this withdrawal of money from the banking system is used when they're raising interest rates, and this is basically trying to control growth and inflation from overshooting the central bank's 2% target. In either instance, the money supply will affect the value of a currency, as the supply of a currency is one of the two factors that determines the supply and demand equation that derives the value of a currency in the markets. We'll talk about this more later, but that's just a fundamental understanding of why central bank increase or decrease the money supply, because they're trying to get inflation to either hit the target or come down from the target if it's too high. Then on the flip side, what the central bank is doing with interest rates is going to affect the demand for a currency, because what I'm going to show you guys is interest rates have a massive impact on the currency markets. So basically, when we're trading, we need to be understanding what's happening with inflation inside of a certain country, because if inflation is going too high, we know that the central banks are going to try to withdraw money to control that inflation, and that makes a currency very attractive to investors, which I'll explain later, and we buy that currency when interest rates are going higher. Or on the flip side, if, let's say, for an example, the central bank wants to increase the money supply and lower interest rates to try to stimulate growth, then that basically means the currency is less attractive in the forex markets, which again I'll explain later. And then markets don't want to be owning their currency, and that makes the currency weaker in exchange rates. So also, on the flip side of that, the demand for a currency can also come from not just interest rate changes, but also from the exports of a country, because the demand for a country's stocks, bonds, and the currency can also be a big driving factor to how much the currency is in demand backed by the markets, as well as, for an example, what is a currency selling that's making the demand for their currency be very strong in the market. So what I'm going to be touching on also next, we're going to look at the commodities of a country, because if a country's selling a lot of oil, and let's say the oil price is going higher, that could mean a lot more money is coming in to that country to buy the barrels of oil that are going higher, and that in respect means that the currency will be going up in value. I'm going to speak on this a bit more in detail just so you understand. Now, a fixed pegged exchange rate is different from a floating exchange rate, because in the floating exchange rate, the currency's value is basically being dictated by what the central bank is doing with interest rates, or what's happening with the exports of a country if they're selling commodities, for an example, and their commodities going up in value, which I'm going to touch on as I just said. On the flip side, if a country is selling a commodity and that commodity is very, very important to the economy, what some central banks will do is they will purposefully fix the value of their currency into another currency, usually the US dollar, because a lot of commodities are sold in US dollars. So countries, for an example, like Saudi Arabia, that has a large proportion of its national income is reliant on selling oil. What they're going to do is they're going to peg the value of the Saudi Arabian currency to the US dollar at a specific exchange rate price. So exporters of oil from their country know how much they're getting for each barrel of oil that they're selling in the markets. Because if that exchange rate was to rapidly change, for an example, and let's say the Saudi Arabia's currency got too strong against the US dollar, that basically would mean that less barrels of oil could be bought for each US dollar sold in exchange for the Saudi Arabian currency, and that could basically hurt their exports. So what they want to do is they want to make sure that their currency is fixed at an exchange rate, so businesses who are selling oil can make sure that they're forecasting how much they're going to be selling and doing their budgets properly, and that also helps the Saudi Arabian government budget how much they're going to be spending on public services, for an example. So basically, when you have a fixed paper exchange rate, they're basically protecting their exports and making sure that the currency value doesn't wildly swing up and down that could really affect the budgets of a government and businesses that are selling the major commodity of a country. We also have some certain countries that are pegging their value of their currency to another currency, like the Danish kroner pegs its value of the currency to the euro, because Denmark is selling a lot of their goods to Europe. So they want to make sure that their currency isn't going too high against the euro, to make sure that they can keep selling their exports into Europe at a predictable price to help their economy. Could also, let's say, to help the government. The Hong Kong dollar is paving into US dollar for another example. But we're also going to look at which currencies are pegged, because basically when you have a pegged exchange rate, there's no volatility in exchange rate for us to make money from. We don't want to trade pegged exchange rates. We want to be trading floating exchange rates, because these free move up and down in value based on the supply and demand of a currency. So when we look at ex-commodity floating currencies, these are basically currencies that are not exposed to price changes of one or two commodity exports. So for an example, the United States doesn't have a large majority of their exports are not coming from oil, or they're not coming from gold. So if the oil price goes up or down, it doesn't really affect the amount of exports they can sell to the rest of the world. And basically all these currencies we're looking at here are currencies that are not affected by commodity prices. Okay, so these are freely floating exchange rates based on the supply and demand for the country's currency, and that is also being driven by, as I was saying, the exports, but then also the monetary policy being set by the central bank of interest rates because of inflation. Commodity floating currencies are again exchange rates that are not pegged, but the value of these currencies are greatly affected by commodity prices. So I want to show you, for an example, how much oil prices can affect the Canadian dollar or the Norwegian kroner or the Russian ruble, because they are selling a lot of their oil to the rest of the world, and the oil that they're selling is a large proportion of their exports. So if oil prices go up dramatically, they can really strengthen the commodity currencies that sell oil. For an example, if the oil price drops dramatically, you'll see these commodity currencies weaken considerably, because there's less money coming into the country to buy those oil barrels, for an example, and that affects the value of the commodity currency. So these are all the currencies basically that have high volatility. Commodity prices move up and down quite aggressively in the markets, and that's why these currencies are very, very volatile, and that basically means that we have more opportunity to make more money if we're trading commodity currencies than not commodity currencies that are very predictable. In terms of the only time you see the US dollar really getting stronger or the euro really getting stronger is because something's being done by the central bank that's making the currency come into high demand in the markets, for an example. Ex-commodity pegged exchange rates, as I was saying, they're just countries that are pegging their exchange rate to the value of another currency, like I said, the Danish kroner or the Hong Kong dollar, because they are basically making sure that when they're selling their goods to that specific country or that specific economic region, that the exchange rate value cannot affect their exports and not hurt their economic growth. So these currencies are not selling commodities, but they are pegged because their government and central bank want to make sure that the exchange rate does not hurt business exports and economic growth and the budgets of these governments. Then we have commodity fixed and pegged exchange rates, and that was exactly what I was talking about earlier, guys, where you have some countries in mainly the Middle East, and because they're selling so much oil that is very, very important to their budgets or then taking care of their people. They don't even want to run the risk of allowing their currency to fluctuate up and down in value, because it will really affect the budgets of these countries and businesses as well. So we have 46 total currencies, 36 are floating exchange rates, and 10 are pegged and fixed exchange rates. So we obviously want to pay attention to the floating exchange rates, because that's where we have volatility. If we're not paying attention to floating exchange rates and you try to trade a fixed exchange rate, you're not going to see the exchange rate move, because the central bank makes sure that it fluctuates within a tight range every day and it doesn't go beyond that range, so you can't make money from exchange rates. And when we're looking at this exchange rate, we're looking at this tradable set of currencies that we can make money from. We want to be understanding, okay, so for currencies that are not exposed to oil prices or any commodity, then we know that it's the central bank's monetary policy that would affect the value of these currencies. And with the commodity currencies, central bank policy will also affect these currencies, but also the oil price or the commodity price of their main export can have a big impact on these currencies, and these are very volatile, and these are the currencies that we can make the most money out of when we trade in the currency markets.